Hello, this is Steve Malone with Compass FX. I hope you're doing well today and you're getting some good trades. Over the last few years, there's been a term that has gained a lot of popularity, and almost every day we hear it in the marketplace, and that is risk-on, risk-off trade. And I've had a number of folks recently ask me, what is a risk-on, risk-off trade? And as a Forex trader, what do I need to be looking for to trade a risk-on, risk-off trade? So in today's video, I'm going to give you a basic overview of the risk-on, risk-off trade. Why does it exist? And what are people looking to do with the risk-on, risk-off trade? And how you as a Forex trader can benefit from it by looking at one specific currency, which gives you evidence of risk-on, risk-off. So what is this risk-on, risk-off all about? It all boils down to sentiment in the marketplace. When investors feel better about the global economy, especially the U.S. economy due to some favorable economic reports, they seek out riskier investments such as equities and world currencies. However, when fears start to rise, investors get out of these riskier investments and they move into fixed assets like U.S. Treasuries and bonds. This correlation between risk and fear is equally matched to a correlation in asset classes, going from riskier assets into fixed assets. Now, correlation is a big word, but just simply means that two assets tend to move together. When one investment goes up, another investment, similar in some respects, goes up with it. And when one goes down, the other one goes down as well. So, for instance, you might have noticed here lately that sometimes the Dow and the S&P will start making a strong move up. That's an equity market. While at the same time, the euro dollar and the pound dollar will rise. Well, that shouldn't be the case, because a few years ago, if you remember, when the Dow went up, the dollar got stronger and we saw the euro dollar and the pound dollar go down, but that's not the case anymore. Let me explain a little bit more in detail specifically to the Forex market. It all comes down to the central bank interest rates. And I've got a little snapshot here I want to show you. Now, take a look at this list. You can see here's the Aussie dollar, the central bank interest rate, the overnight interest rate is 4.5%. If you look all the way down to the bottom, the overnight interest rate through the Bank of Japan is only at best 0.1%. Now let me ask you this. Suppose for the moment you had a little nest egg that you wanted to invest. And you go to your banker and your banker says, well, with all things being equal, I have two vehicles. One is paying, let's say the US dollar here, one is paying 0.25% interest, while the other one is paying 4.5% interest. Which one would you like to do? Well, I know that's a rhetorical question. We would all go for the 4.5%. Well, that is what the world is doing in the risk-on, risk-off trade scenario. These large institutions, these what we refer to as model funds, which are oftentimes pension funds, what they will do if all things being equal and there's a favorable sentiment in the marketplace, the U.S. economy looks good, it's robust, or it seems to be robust or getting stronger, and all things seem to be well, folks will go out and they will sell the dollar and go out and buy a higher interest-bearing currency. That's why we see the euro dollar going up and the pound dollar going up as the equity market moves up. So there's a correlation here. Equity markets are moving up stateside here in the U.S., while at the same time we see world currencies moving up. We have riskier assets making a move. Now, when some report comes out or somebody says something that seems to be less than favorable, and the world seems to be, oh my gosh, what's going to happen now, and running for cover, then folks come out of the riskier assets and back into U.S. Treasuries, and that's when we see the dollar strengthen. So that's the risk-on, risk-off trade. Large institutions, all the way down to small hedge funds and money managers, go out and they will sell the dollar and buy higher interest-bearing currency in the Forex market. And what happens is they're looking for the market to continue making a risk on scenario, and they can hold into their positions and take the difference. If you imagine in this case we sell the dollar and buy the Aussie, there's a 4.25% differential. That's a nice little chunk of change just from holding a position for a period of time. Now I realize that there's up and down flow in the marketplace, and there's profitability and there's loss depending upon holding the position. I understand that, but just look at the differential here. From a simple understanding of the risk on, risk off trade, that's what's taking place. The world thinks all is well. They go out, they'll sell the dollar, they'll buy higher interest bearing currencies. They think that things are terrible, you better run for cover, oh my gosh, the world's coming to an end. They'll come out of the riskier assets and they'll immediately run back into U.S. Treasuries because the U.S. government will back U.S. Treasuries. So that's the basic overview of the risk on, risk off trade scenario. Now let's consider for a moment. If I'm a Forex trader and I'm looking at these interest rates and I'm knowing that, hey, if all is going well, they're going to dump the dollar and go out and maybe buy Aussie or buy the Kiwi or buy the euro, the CAD, or the pound. Well, there's a pair here from opposite ends here. We could be really looking at the Aussie yen. The Aussie yen, I often mention it in my live active trade room because it is the risk on, risk off currency pair. It literally shows you as the market gains risk on sentiment or drops due to risk off sentiment, we can see the immediate effect in the marketplace. So what I want to do is I want to just quickly go over and show you the Aussie yen. We can see the scenarios of a risk off scenario and a risk on scenario. Risk off scenario, and literally just as of this past Friday, the Aussie yen has made about a 325 point move up from where we were right around the Thanksgiving Day holiday. Take a look at this. Look at the pound dollar. The pound dollar had been coming down as the Aussie yen was going down, but look what it's done since the Thanksgiving Day holiday. It's pushing back up. And even with all the sovereign debt crisis issue in the Eurozone, look at the euro dollar. Even though it had pushed down since the Thanksgiving Day holiday, it is starting to make a little bit of a push back up and made from this low point to this high point about a 230 pip push up in a risk on sentiment in the marketplace. And if we take a look at all three of these equally side by side, you can see as the market gains a risk on perspective, we can see the pound move up, we can see the euro dollar move up, and also do yourself a favor, go check the Aussie dollar. It has made a strong move up along with the Aussie yen. And the Aussie yen continues to push up. That is a risk on scenario. Look for the Aussie yen to turn over for a risk off scenario. So let's say, for instance, later this week there's some bad economic reports that come out. The ISM manufacturing number is worse than expected here in the U.S. The non-farm payroll number is not as good as expected. Bad numbers for the U.S. We could see literally a sell-off in equities, and I would bet you we would probably see the Aussie yen fall back down. We would see these higher interest-bearing currency pairs tend to sell off as well. So look for that. Consider again the central bank interest rates and how the market plays out. So if there's positive sentiment in the marketplace, expect market participants to sell the dollar and move out to higher interest-bearing currency just to hold those for the interest rate differential. When there's a negative sentiment in the marketplace, look for the market to come out of these and back into the US dollar. Well, folks, this is Dean Malone with Compass FX. I hope some of this information will help you in your trading. Keep an eye on the Aussie yen because it is the risk on, risk off currency pair. Y'all make it a good day and get some good trades. We'll talk to you next time. Bye-bye.